Hi, my name is Shreyans, and today we are going to do a basic financial analysis of a company whose products someone in your family, an elder person, might have used. You might have also heard about the company, but wouldn't be able to easily connect the products and its name, right? I am talking about a leading pharmaceutical company of India. But before we start, please remember that this is not investment advice. We're just trying to understand the financial performance and position of the company. So let's get started. The company that I'm talking about is Cipla. It's sort of a household name and it's part of the Nifty index as well, so you can understand how large it is. It's a pharmaceutical company. It manufactures medicines and APIs. What sort of diseases does it treat? So diseases related to breathing problems, eye problems, skin diseases, even nicotine problems, and all the sorts. And it also manufactures some APIs. APIs are used in the process of manufacturing medicines, right? So let's start with the financials of the company and then we'll come to the highlights later on. Okay. So when we talk about revenue, EBIT and PAT, the thing to look out here for is that revenue has gone up 2.7x, right? Which is a decent CAGR of 11.7%. But the challenge here is that this has not translated into the EBIT and earnings. So EBIT is up only 1.8x and PAT is up only 1.6x. So this is a sort of a challenge that, okay, its revenue is growing at a decent rate, not the best of rates, but still a decent rate. But the growth rates of EBIT and PAT are sort of very poor, right? Because EBIT is only 6.6%, PAT is only 5.7% CAGR, right? And also the thing to look for here is that in the recent years, the growth has been very poor. So the growth rate in revenue in the recent years has been very poor. So this is also a challenge, right? Because revenue growth was pulling a lot of what was happening with the financials, and now revenues also weakened up. So this is something to watch out for. Okay. Now talking about the items of the cash flow. So we have cash flow from operations, and cash flow from operations cumulatively is about 17 to 20 CR, which is comfortably greater than the PAT, right? And if you look at here, the growth here is up to 3x, right? And the CAGR is 13%. So if you could compare CFO with revenue, then you could probably say that, okay, the company's cash generation has been fairly decent, has been solid in context with revenue, and very, very good in context with earnings as well. All right. Then talking about the other two items, so cash flow from investing and cash flow from financing. So this is where we have to go beyond the numbers that we just see here, right? So if you look about the cash flow from investing items, it is understandable that the company will have a lot of outflows, right? And these outflows would majorly relate to the fixed asset investments that the company makes, right? Because it's a pharma company, it has to invest a lot in R&D as well, and a lot in manufacturing capacity as well to maintain its capacities, because all the manufacturing is also, very strictly regulated. So that is understandable. But also the thing to notice here is that the company has been making investments and redeeming them in the same year, right? So probably placing whatever excess cash that it has into short-term investments. So for example, you see a figure of, let's say, 900 crores outflow here. So it is quite possible that there was a significant part of this 908 CR is actually net, on a net basis, the asset purchase. But the company might have had excess cash of, let's say, 1500 crores, which it would have placed on deposit. And it also sold it during the year for, let's say, 15-20 crores, right? So small amounts here and there changing in net investments, right? With cash flow from financing activities, so this is slightly up and down with inflows and outflows both. The thing to notice here is that the company raised borrowings here, right? And actually the company also raised borrowings in FY17. However, it repaid this part of borrowings. So this was probably a short-term borrowing, and then the company took long-term borrowings and it has been repaying it, right? So otherwise, I mean, one part of this is also dividend payments. Company has been consistently making dividend payments, not very high dividend payments, but reasonable dividend payments, and they have been continuous. And there is just a couple of borrowing issues which is being, repaid comfortably. All right. Now coming to the items of the balance sheet, and we'll also talk about, liabilities here. So equity has gone up 2.4x. So it seems reasonable. I mean, it seems somewhat in line with the revenue, and that seems okay. If we talk about, if we compare the liabilities versus equity, so starting with the non-current liabilities. So what we would see here is that there was a cash flow from financing in here. It was an inflow, right? But the non-current liabilities did not increase. And what you see is a sudden increase in current liabilities, almost doubling here and then again going back down here. So this is why probably what I understood when I went and looked at the breakdown is that this was a short-term borrowing, but then this was paid back here, and then the company financed that repayment using a long-term borrowing. So it's practically the company converted its short-term borrowing into a long-term borrowing, and then it has, it has been paying it back slightly, probably raising some new parts as well, and here is a significant decrease as well. And if you compare this figure with the equity figure, so it's about 3,000 CR here and it's about 15,700 CR here. So I mean, the solvency position is also quite comfortable. There's nothing to be alarmed about. So the borrowings level are well in control. The non-current assets have gone up. In fact, the non-current assets and also the working capital, which would be, let's say, cash, current assets less current liabilities, right? So all of them have increased broadly in line with revenue, right? So you see a 2.6x in current assets, 2.5x in non-current assets, and again a 2.6x in current liabilities. So if you look at the growth rate of assets, so growth rate of assets is about 11.1 CAGR, which is in line with revenue, and also the growth rate of the working capital, which is current assets less current liabilities, again 11.5 CAGR here, which is again in line with revenue. So the company has been, reinvesting into its resources, and it has been able to, maintain the ratio of revenue to assets as it has been working all around. Okay, so now coming on to the growth, although we have discussed some bit of it, but let's just go over it. A few specific points to look out here. Now, with revenue, as we talked about, this is this is single digit growth actually, and revenue growth was the strongest out of the financial statement items, and that has also started to weaken. So this can be a sign of a challenge, although revenue has not increased. So that is in a way a good sign. EBIT and PAT have been inconsistent, right? So you could say that EBIT and PAT have fallen for 2 years in a row here, then they fell 1 year again, for 1 year again here, and then they have been increasing, right? And this is something that you would find in a pharma company, right? Because when you invest and when you get the returns of that investment, those are not immediate, right? The returns come in on a delayed basis. So this is something that might be characteristic of pharma company as well. But I mean, there, at least in this year, it was a very, very sharp decline, right? There might have been a write-off, somewhat of write-off here as well. So, and due to that, the revenue growth hasn't really translated into the EBIT and PAT growth, right? Cash flow from operations, it's been more or less solid. There've been a couple of years where it has gone down, but in most of the years, the cash flow from operating activities have been greater than the PAT, right? Equity, a solid growth here, and then again in the recent years, more or less, it's going alongside the revenue growth, roughly, not exactly, but roughly, right? Assets have broadly increased just a couple of years when the asset base declined. So, I mean, we'll have to see how the company, goes forward with its manufacturing plan. The working capital has been slightly volatile, right? Because obviously one sort of very heavy increase here in current liabilities as well. So if you look at the current assets less current liabilities, so it's more or less, increase, decrease, and one very sharp decrease here because of the increase in current liabilities, and then it's fallen again. So, but that's understandable. More or less, it's been going along. How the revenue has been going along, right? So, and of course, there are some items that keep increasing and keep decreasing. With liabilities, liabilities saw some increase here in these years when the company probably raised borrowings. Then overall, it has been a declining trend, and the company has been repaying its borrowings on time. So that is the more important thing to watch out for here. All right. Now coming on to the key metrics here, and we'll start with the ROCE and ROE, which I feel are quite important. So the thing to look out for here is that the company has had decent ROCs and ROEs. So these are not very high numbers, but these were decent till this point, so to speak, right? So in these 6 years, these were decent, but in the recent 4 years, it's been very, very problematic, right? So you have just out of the recent 4 years, in 3 years, it's been, single digit return on capital, right? And in 2 years, single digit return on equity, and all whichever has been double digit, it's just in the 10% vicinity. So, and you could look at the median and mean here are 12.9 and 11.5%, and in the 4 years actually it's always been below median. So this is a cause of concern, and let's try to understand that why the company is unable to generate the return on capital and return of equity. So if you look at the margins have broadly declined, and it's gone down from as high as 22.6 and 18.7 years. So these 3 years or even so these 3 years were very strong, but then it started declining and it went all the way down to 8%. So you could imagine from a high of 22.6% to a low of 8%, and here from a high of 18.7% to a low of 7%. So this was a very challenging year, it seems, for the company. And then it has again, started fairly, on the uptrend, but let's see how far it can go back up and if it can even recover to these levels, right? Because if it can, then it might be a good sign, but it remains to be seen. And the pad margin has actually sort of stabilized, so it might be difficult for it to go back up to, let's say, 15, 16, or even 18 percentage. But let's wait and watch how this turns out to be. But margin declines seems to be a very big problem, right? So if you look at the fact that the revenue growth has stagnated sort of, and it's been very low, and the margins have also declined. So this is like also a double whammy. Sorry, margins here. So revenue decline, revenue growth decline, and EBIT and margin, PAT margins contraction. So this seems like a double problem for the company. Now looking at the other part of return on capital and return on equity, which are the asset and capital utilization ratios by capital turnover and asset turnover. So if we look at the broad trend, it has been maintained, right? So this is what I understand here, that this has broadly been maintained. It has been in a sort of range here. So only in capital turnover, it was a minimum of 0.82 and a maximum of 1.05. But in asset turnover, the ratio has been broadly been maintained in a specific vicinity. Capital turnover increased highly in this year probably, and which was probably due to lower non-current liabilities or maybe a smaller increase in equity. But apart from that, it has been fairly stable. So the company is able to maintain its asset utilization even as it increases in size. So this is a good sign, so to speak. Talking about assets by equity now, some sort of leverage and solvency and liquidity positions. So if you look about the assets and assets by equity, it's been below 2, right? So the company is fairly comfortable with its leverage position. It has some leverage, but it is able to manage its leverage. It's not at a point where it is getting difficult to manage the leverage. And it has, you see, the maximum here is 1.83, and which was when the company raised borrowings, and since then it has been below that. Cash flow to PAT, as we saw, it's in most years it's greater. The cash flow from operations is greater than the PAT. Net cash flow, so to speak, so it's been increasing and decreasing, right? Because of reinvestments into assets, because of borrowing transactions, raising borrowings, repaying borrowings, paying some sort of dividends, placing excess money on deposits, then redeeming that money. So that is why it's that sort of these sort of figures for the net cash flow. We talked about the current assets less current liabilities here already, that how the trend has been going on. The non-current liabilities to equity, so you could look at here, the maximum has been 0.36. So as very understandable, the leverage position has been quite comfortable and the company is actually on track to repay its borrowings. Although the company might also raise its new borrowings if it repays the existing ones, because it has sufficient room to raise borrowings, and then it also can get capital for expansion. All right. So now let's quickly wrap up with the highlights. Now revenue growth, as we've seen, hasn't translated into EBIT and PAT growth. So that is a sort of a challenge. Poor revenue growth in recent years, inconsistent EBIT and PAT. So that is, sort of the two challenges that we see here out of the bat. Cash flow greater than PAT. So this is also a good sign. If you look at the cumulative CFO, the cumulative CFO is 7,220 CR and versus a 13,200 CR of PAT. So it's comfortably more. CFI includes reinvestments and investments purchase and sales, as I explained earlier, and CFF includes borrowing transactions, issuing and repaying, and dividend transactions as well. So equity has gone up 2.4x as we saw, and the company has raised and repaid borrowings, but the leverage position is very comfortable. Max non-current liabilities to equity of 0.4x and max asset to equity of 1.83x, right? Now talking about the asset utilization, the growth in fixed assets and also the working capital, which is the net of current assets and current liabilities, it's mostly in line with revenue growth, right? At least the working capital has been slightly inconsistent, but broadly it's been in line with revenue growth. The return on capital greater than 15% in just 2 out of the last 15 years. The return on equity greater than 15% in just 1 year. So this is, this is why where the challenge of growth and low margins comes into play, right? And it has been below median in the recent 5 years. So that is a problem. Now, EBIT and PAT margins have contracted, currently recovering from the lowest in FY17, right? So FY17 did not seem to be the best year for the company, and let's see how well it can recover. It's still recovering. Now, capital utilization or capital and asset turnover have broadly been maintained, or I would say even improved. So this is a good sign for the company. So what is the broad summary, so to speak, of what is the conclusion to make is I understand that the company has a strong financial position in terms of leverage and capital utilization, but it is struggling to generate sufficient returns on that capital, right? Due to the poor growth and due to the contracting margins. So we need to look out for the fact that company is although financially strong, but until and unless you have better growth and you have slightly improved margins, it will be a challenge for the company to consistently generate the returns on capital that are sufficient. All right, so that is all that I had to share about the company. If you found this helpful, then please share it ahead. If you have any questions, then you can drop them down in the comments and I'll get back very soon. If you want to receive updates about videos such as this or more investment research, you can subscribe using the link in the description. This Excel sheet is also available in the description. And if you have any feedback, please let me know. I'll see you again with another company. Thank you so much for watching.